All right. Well, back by popular demand. For, listen to the Byte Club Podcast. This is episode 19, I believe. But we had Marilyn Landis on before, and she was very popular. We got a lot of questions about her podcast when she was on our podcast about her interview. She gave a plethora of really interesting and awesome information about investments, loans, and raising capital for your startup companies, not only in the tech world, but just in business in general. So we're back to kind of have another discussion about raising capital, raising money for a business, startup companies, apps, software, whatever it may be. So we're happy to have her back. But interestingly enough, as we're recording this episode, big news around, kind of the banking world. And, the Silicon Valley Bank and kind of the run on the bank there. So I know you probably have a lot to say about that. So if you want to kind of touch on that a bit, that'd be fantastic.
Absolutely. And that's a big part of funding. So often a startup will say, well, eventually I want to get a bank loan. I want to get a bank loan. I've got it some high priced or I'm going to get some investors, but eventually I want to get a bank loan. What do you do when a bank loan may not be your best option?
Right.
All right. So a couple sides of what's going on right now. One was Silicon Valley Bank. Remember, they were doing a lot of investing in tech companies. And anyone listening to this podcast thinks about, well, how stable have the tech companies been in the last month or so? 10,000 layoffs here, 30,000 layoffs there. We're tired of having all the losses. We've been too inefficient. We ramped up too fast. The heads of the companies are saying this. Mm-hmm. So if they're saying that, okay, and maybe you think, well, that's big. That's Meta, or that's one of the big ones. They're okay. But their subcontractors, their customers, they're touching everybody. So if they can't pay, if they're downsizing, they're no longer using some of the people they were using before. They're cutting back on those contracts. So it's working its way all the way through.
Right.
Well, Silicon Valley had a lot of those kinds of companies from big to small that it had. So what does that mean? Well, people think of a bank as its deposits. That's not a bank's asset. That's a liability. That's other people's money. Its biggest asset are the loans. What if those loans are starting to get weak? What if they're starting to look a little bit shaky? A bank is supposed to risk rate, which means what's the risk of it going bad, and keeping reserves in balance and so forth. A bank that chooses to be in what others perceive as a higher risk area, like tech, either has to have higher reserves or be smarter about how it does its business, know its industry better. And Silicon Valley had a pretty good reputation for really understanding the tech industry and knowing how to do that. But when it all came together with all that's happened with all the Amazons and everybody else and all their layoffs and everybody else that's gone with that, it's no wonder that Silicon Valley began to worry about its reserves. Maybe we don't have enough. What happens if some of these loans go bad? So what they chose to do was sell some of what they hold, in this case it was U.S. Treasuries, as their backup. Mm-hmm. Well, interest rates are going up. Anybody listening to this knows that.
Right.
But if you bought a bond with a very low interest rate at the days when that was a good rate, and now the market rates are higher than your bond, nobody's going to pay you face value for it. So that's what Silicon Valley was facing. It's trying to get what they call liquidity. In case these loans go bad and people want their money, the depositors, they've got to make sure they've got it. They had to sell those at a loss. And that's what just blew up across the media, was that they had this huge loss, and that was from the sale of these bonds. And there's a panic. And that's what a bank run is a panic.
Panic.
Everybody thinks they don't give the bank time to work it out. If a small business has an issue and they need time to work it out, they can do Chapter 11 and simply say to their creditors, pause, mm-hmm. We'll figure this out, and then we'll come back and make you all whole. Banks don't always get to do that.
Gotcha.
There's this huge run, and everybody wants their deposits. And that's bleeding over because we tend to think of the banking industry as rock solid. It's not really. If you think about all that's happened through COVID, there's a lot of things in a bank's portfolio that people are now questioning, regulators are questioning. In many cases, the banks were not looking hard at the financials that were coming in from their borrowers, not because they were being stupid, but because they said, oh, that's COVID. That's an outlier. That's COVID. And the regulators were encouraging that. We understand. Well, suddenly now, 2022, fourth quarter, mm-hmm. 2023, they're coming going, wait a minute. These businesses aren't bouncing back the way they should have, or they're not doing this, or not doing that. So there's a lot of pressure on the banks. There's pressure to reevaluate the risk of some of those assets that it has, to maybe force people to pay them that have been on forbearance or forgiveness, not forgiveness, but forbearance. So all of this is stressing the banks. At the same time, there's something called the Banks Security Act, which is they're really scrutinizing anything that goes in and out between other countries, looking for money laundering and all that sort of stuff. Well, that's an extra pressure on the banks. And then there's pressure on the banks that they're lending to the right people in the right locations. There's a lot of scrutiny on the banks right now. And with all that pressure, there's going to be some cracks. Anything under intense pressure starts to crack. Doesn't mean it's going to fall apart. But if the media catches a chunk falling off and announces that the world's going to end, then there'll be a run on the bank.
Right.
Now, how does that affect the folks that are listening to this? One, most small businesses would thank their lucky stars if they had more than $250,000 in the bank.
Absolutely.
Right?
Absolutely.
And that everybody's insured up to that amount. That's not a question. If you have an account in 2 names, each name is insured up to $250,000. So for most small businesses, that's not the issue. What is going to be the issue is when the banks are trying to straighten things up, they're likely to be collateral damage.
Gotcha.
The rules come in and suddenly they don't fit anymore. And that's going to be the hard part. So being those, and I said this going in before COVID, I said those who are being forced to pay higher rates outside of the banks, non-bank lenders, are paying true market rates for the money. And they're adjusting their pricing and their overhead and everything to fit those rates. Those who people thought were lucky, who could get lower bank rates, didn't have to make that change. Mm-hmm. Now that rates are going up and inflation is going up, those who were already built that pricing into their model, they're fine. Those who didn't are being crushed.
Gotcha. So do you think that this is going to force banks to be more conservative? Because we kind of talked about this before we got onto the show here, but traditionally speaking, a lot of banks don't touch the tech startup companies because a lot of these tech startups, they are raising a lot of capital, spending a lot of money, and they don't really have any revenue coming in. A lot of the game of the tech world, these mobile apps, software companies, they're trying to get users for free because they want to establish a user base, and that's how they can eventually sell and acquire revenue. So we had kind of talked about how banks traditionally don't kind of loan money to these types of startups or organizations, but at Silicon Valley Bank, they kind of specialize in the tech world. So do you think this is going to kind of create a shock throughout the banking industry that makes all banks be more conservative about investing or
Let's be careful how we use the term conservative. Let me tell you what I mean. Pre-tech world, being intense, conservative meant we only lent against real estate. So that's why the techs had trouble getting money. They tended not to own a big building. They didn't have big pieces of equipment. They weren't construction with hunks of yellow iron. All they had was their know-how and their ideas and maybe some branding and some patents and some things like that, which is traditionally not what the banks were looking for. So they either wanted to see serious cash flow or they wanted to see that you had some hard assets to lend against. When they would tighten credit, they'd go back to only taking real estate. Well, as we've all had this conversation, have they looked at their real estate lately? That building might be 80% vacant. Mm-hmm. It might have deferred maintenance, or the building might still be fine, but the neighborhood is gone. The people who used to use that building no longer come there. We're having this great shift in real estate, and the banks are just, phrase I use, it's not derogatory, but they're just coming out of the basement to look at the real world. And they're kind of looking around going, oh, that used to be a thriving shopping center. There's nobody in there except our client. Oh, that's going to be a problem.
Right.
All right. They're just beginning to assess this. At what level are people coming back? How are they coming back? And so forth. So I'm not sure what conservative is going to look like. Because they're trying to fill that out themselves. That's why I said the collateral damage will come in. They're trying to figure out what they can do that the regulators will say is okay. That's the hard part. Traditionally, what it takes in banking is a history. So you build a history to say, if we've always done this, this, and this, our losses will be 1%. Well, you haven't got time to build that history right now. You got to change it overnight. Mm-hmm. So the regulator said, well, you can't prove your 1% losses, so you have to put up 50%. Oh, great. I lend $100,000 and I got to put $50,000 up as backup? How am I going to make enough money on the other $50,000 to pay for that 50?
Right.
Okay. So this is going to be where the businesses are going to get caught in the middle. The good banks who have really been paying attention to the underlying, what I call the credit, the reality of the business. Is it a strong business with good management? What's it doing? Where's it going? Other businesses, think about, why are the techs laying off some of these people? Because they were going in the wrong direction with too many people.
Mm-hmm.
And the market shift. Suppose you had a customer that was doing great pre-COVID. Nobody's buying that product right now. All right, so this is what's going to be the hard part, is seeing what is. Are they going to tighten? Absolutely. And the first reaction, obviously, when you've got a regulator involved, is that knee-jerk reaction.
Right.
No.
Right.
I mean, that's the first reaction is going to be no. But if they don't lend money, they don't make money. So it'll be interesting to see. And I don't want any businesses to get caught in the middle. The less you have to borrow right now, the better.
Right. So that's interesting too. You kind of touched on, regulators. And so maybe we can talk a little bit about with this whole Silicon Valley Bank thing.
Mm-hmm.
There wasn't anything that was illegal that was done. So
Mm-hmm.
don't think there'll be any sort of new regulations coming out on this.
Oh, there'll be a lot more regulations. Unfortunately, when something goes wrong, the general trend across our regulatory agencies is we didn't do enough of it. It's called double down.
Mm-hmm.
It didn't work, so we're going to double down on it. Doesn't make we're going to make the regulations smarter or better. One analysis I've already read, famous Dodd-Frank was supposed to solve all kinds of issues. It didn't solve this. Credit Suisse is having issues. Some of its issues were never detected by it. So more regulation is not the answer. Better regulation is the answer.
Gotcha.
All right, and that's going to take a real conversation about what works, what borrowers are going to have to speak up. They're going to have to speak up with what they need. People listening to this need to be getting in groups. I have part of a national group. I was part of a national conversation yesterday about this.
Mm-hmm.
And we're going to be talking about what are the policies that we should be pushing for. So you're familiar with this is NSBA.
Okay. Yep.
What are the policies they should be pushing for that will help people get the funding they need? This is a discovery because we're trying to, so we were listening to, we had probably maybe 100 people on the call yesterday, and we're listening to what they need and first you start with what they need. Like, for example, one of the pieces of legislation that somebody wants to vote, he thinks is going to be a big help. This is going to help small business. Going to make it easier for a small startup to be an ESOP. An ESOP is an employee-owned stock option company. Problem with ESOPs are, if you're a growing company and you want to give a little piece of stock to one of your employees, you couldn't give them, it's like giving them a stone. They can't sell it.
Mm-hmm.
There's no place to go with it. They may have to pay tax on things. So why would they want it? And when they leave, you've got to pay them for it.
The employee pays.
You pay the employee to buy it back. All right, the ESOP is a very formal structure.
Mm-hmm.
All right, where all the employees have ownership. They all have some say and they all get information. You've got to do annual reports and you've got to do all this. In certain situations, it's great. I've seen companies where they have a core of good management. They convert to an ESOP, they bring key employees with them, and it's great. But it isn't for everybody. So I said, one woman said, well, would it be good for this legislator to push this to make it easier for small businesses to get an ESOP? I said, please tell them to take all that energy and all those resources and help us get us the money we really need.
Right.
Because an ESOP doesn't give you money. The employees don't buy it from you. They have to go out and borrow the money to buy it from you.
So, and who sets the price that
You have to have
price?
valuations done, and there's
Okay.
a lot of regs around that, and how the valuation is set, and how it's handled to be evaluated every couple of years. So in some cases, it's great, but it's not a funding mechanism.
Okay, that was going to be my next question. Is that
It's an exit
creative
strategy
way?
for the owner.
Okay. So not a funding strategy, an exit strategy.
Right. So I said, tell him please to take his resources and his time and do something that would fund. Because there are great businesses out there, contrary to what you see in the headlines.
Mm-hmm.
The real entrepreneurs today are seeing opportunity.
Oh yeah.
They're seeing new markets. They're seeing new ways to do things. They want to capitalize on it. They want to figure out how to do it. How do I make this happen? If I get just this little piece of automation, then I free up the money and I can go do this that I couldn't do before. And they're going to need funding.
Mm-hmm.
And so we don't need old methods that may not fit the new reality today. So
Right.
we need these companies to come together in groups and talk about what they're looking for, not just how much money they need, how they're going to use it, how they're going to pay it back, how long they need it, how it's going to work for them and why they're doing it. There was a time early in my career in lending, you could come in and borrow money for 90 days. Signed the note, gave it to you. 90 days later, you came back and paid me back. wasn't an elaborate 10-year loan.
Mm-hmm.
All right. It was a quick hit. You needed it because you had a customer. You got to go buy the inventory so you could sell it to them, or you had to go hire some programmers. And as soon as you had the new algorithms written and the new code, you could sell this product and then you could pay the bank back. Bankers got away from that. And they went into this term loans and lines of credit. Those 90-day notes were quick and fast and cheaper. All right. So we need to reinvent mechanisms. There was a guy years ago had an idea. Well, why don't I backstop somebody who's got a great idea, a tech idea, and maybe he's got a patent, maybe he doesn't, maybe he's got some other intellectual property. So I say to the bank, if we value that intellectual property at $1 million, you use that as collateral for your loan. If the loan goes bad, I'll buy it back from the bank for $700,000. Mm-hmm. That way you can lend them $700,000 because that's guaranteed. And somebody says, "Guy, why would you do that?" He said, "That great technology, and I get it for less than it's worth. You don't think I'm going to make money on that?"
Right.
But that was never codified in law. He had the idea, and then we had a rush on the economy, and everything was great, and that idea got forgotten. We need new ideas like that to come forward with new ideas, new ways to fund the companies that are our future, not the traditional. Yeah, we always will have manufacturing, but it's like if anyone remembers when laser cutting first came in and CNCs and that sort of stuff. The technology in those early machines was more valuable than the machine. Mm-hmm. But the banks didn't know how to finance it because they didn't know how to value the technology.
Right.
Eventually it became standard. Well, we've got new stuff now. We've got to figure out a new way to lend to it.
Right. And that's interesting because, in my business, we see a lot of small businesses or startup companies come and, some of them have really big goals, in mind. They want to, become the next, Amazon.
Right.
And all
That's
power
fine.
to them. Yeah. But I would say the large majority of our clients or prospects that come to us, they want to be a small or medium-sized business and they want to innovate with software.
Right.
And you would be shocked, and I see this every day, how hard it is for a lot of them to kind of find that funding.
It was almost impossible.
Yeah. And, it's as an entrepreneur myself and someone who's very heavily involved in the tech industry and helping tech startups, it's frustrating to see that, it's not the easiest thing in the world to get funding. And then you're kind of forced into going the route of investors, which is great. There's definitely a place for it. But like I said, a lot of these companies aren't necessarily looking like, in my viewpoint on this is an investor is great when I want to be the next Amazon because I know that, okay.
There's a point at which.
Yes, exactly. If I get my, if I get diluted down to 10% of a multi-million-dollar company,
right.
I'm fine with that. You know? But whenever I'm the owner, I'm doing all the work, the labor, I'm taking all the financial risk and all this stuff, and now I'm getting diluted down. And my goal is, maybe I only want to be a $2 million a year company.
Well, the flip side of that, too, is that investor wants out. He's not being there because he's a nice guy or she's a nice person, and she just wants to sit and watch you for 20 years.
Right.
They're hoping for a liquidation event, which is when they get their money back with interest and everything that's going to go with it. If they don't, that wasn't what they got into it for, which is where some companies, and the trouble is too, I have a problem with companies that are said, "Oh, you have to have this mega goal, this big mega goal," right? Why? Why can't I first just get my feet underneath me, figure out what I want to do, test several different things? I've worked with startups, and they get them all revved up, and they go running off in 6 directions, and they hit a wall on all 6. They come back, and eventually they come up with the perfect thing. But it's too late. They've already burned out. The investors say, "Hey, I tried you 4 times, 6 times, Give them a chance. One of the things, and I've been pushing this for a long time, we tell people you got to get a 4-year degree to be an entrepreneur. Why? Okay? Years ago, our grandparents had the GI Bill. They came out of the military, and they got to go to college. Why don't we have an entrepreneur's bill? What I mean by this is not a 4-year degree, all right? You start your company, and you say, I get the software. I'm pretty good at that. But I could really know a little bit more about the biology behind this supplement. I have a client who makes dietary supplements. I need the biology, the chemistry behind the supplement. Why can't I go take a couple classes in chemistry? This bill would pay for it.
Right.
All right?
That'd be fantastic.
Now you're better at your business. You didn't come into that business with a lot of debt. and you can grow. And then maybe later you say, oh, well, it would really help if I took a marketing course. The bill would pay for you to go take a marketing course. All right. What we'd be doing, strengthening our entrepreneurs. Right now they've got debt, so they have to borrow more to survive until they can get through that beginning phase. The other thing is, you mentioned regulatory. Software, I think, has had an advantage because it's not as heavily regulated on all of it. But if you're in the biotech, if you're in anything to do with medical, if you're in any of the financial products areas, heavily regulated. I have a client who can not raise enough capital to finish the last piece of his FDA approval. All right, why? Because it's $500,000. Mm-hmm. And his investors say, and the FDA right now is 2 or 3 years backed up on approval. So by the time they finally look at your package, it will be too old and you'll have to go through all the testing again.
Right.
Which is $100,000 per testing. So we need to find a way to strengthen the company with less debt so that it can be more nimble.
Yeah, I mean, that's a great point. Because the other thing too, and I've talked with you about this multiple times, and I think we even touched on this on the previous time you're on the podcast. But I read somewhere that, and I believe this wholeheartedly, that you're talking about a 4-year degree in college. They teach those kids how to run the top 1%, 2% of companies in this country. Mm-hmm. And the backbone of our economy is a small business. And
that's right.
We're both part of the SBA.
That's right.
And people, I see it every day. You work with small business, I work with small businesses, and there is not a lot of help for these small businesses. You're all on your own.
They really understand small business. You're absolutely right. There's a wonderful book that was written by Robert Slee. And because he said, he realized, just to your point, we teach 100% of our MBAs to run 2% of the companies in this country. We don't teach them how to be entrepreneurs. No slam against the entrepreneurial programs in colleges, but they still don't teach them how to be an entrepreneur.
Oh, yeah. No.
And many of the accelerators and the incubators don't really teach them how to be an entrepreneur. So we need, but that entrepreneurial instinct, nobody has to teach you how to do it. If you've got that drive, all we have to do is enable it, help you understand where you're going, a few basics. I've made this comment before. I hope it's okay for the podcast. I'll say it here. When we lived on a farm, we didn't have to have sex education in school.
Right.
All right? When we were sat at the kitchen table, where Dad came home with his paycheck in cash, farmed out so much to Mom for groceries and so much to you for your school and so on and so forth, nobody had to teach you economics. Mm-hmm. Now it's all beyond our vision. We're not seeing it anymore. So we need to enable people to understand how that works. Then they can make better decisions. And then an accelerator or an incubator says, hey, I've got this idea. And the first thing they're going to think is, how am I going to pay for it and how soon am I going to get the return on my investment? Mm-hmm. Not starry-eyed, oh, wow, I'm going to go off and sell to, No, it's a case of how am I going to do this, how am I going to pay for it. We've got to get away from this idea that all growth should be funded with debt. If you fund all growth with debt, I could do the math for you. You will crash and burn. All right? There's no way. So how do we teach other ways to do that? So if we let a company grow small and incremental, and it paces, but it may have a vision. Mine, for example, is always to take my company nationwide. Always was. But that didn't mean I had to be a big company.
Right.
That's that misnomer. Somehow if you're going to be nationwide, you have to be Amazon? No. So I'm now in 10 major cities, metro cities from coast to coast, with a team of 19, and I'm still a very small business, right? Because I'm more nimble that way.
Right, absolutely.
I can shift and roll with what's going on in the market. I don't have many in this area, if they're listening to your podcast in the Western Pennsylvania area, would be familiar with the old glass factories. It would take days to cool down one of those big glass furnaces, and then there'd be melted glass in there, and you'd have to clean it all out. And then it would be days to raise it again. So rather than, if they didn't have orders, rather than shutting the furnace down, they just kept making glass. I walked into one factory that'll remain nameless right now, and their warehouse was floor to ceiling, wall to wall, with finished product they couldn't sell. They finally turned the furnace off.
That's crazy.
All right. Yes, it is. Yes, it is. But because they couldn't be nimble.
Right.
So if you're nimble, you just flip the switch, go a different direction, and that's what our businesses need. The ones that are working with you are bright, they're smart, they got great ideas, and if that market shifts, they want to be able to shift with it.
Yep.
And that's why my business model is so dependent on that as well.
Definitely. I mean, like, I think, I consider myself very much an entrepreneur myself. We work with a ton of entrepreneurs, and you're right. The entrepreneurs that we see, the ones that are successful, they're very driven, and there is this in my personal experience, I understood the risk.
Right.
I didn't know very much the business side of things. That's where you and your team came in and really helped me out understanding the finances, how to project cash flow, how to, all the things that didn't even cross my mind.
And how to not let the uncertainty hold you back.
Right. And that's the whole thing, is that a lot of these entrepreneurs is we don't need, I don't want to say an education, or we need an education, but not the education of I don't need to know, what I don't know. I don't need to know, how to project.
But you need to know what you need when you need it.
Right.
All right. If I sit you down and gave you a lifetime education on entrepreneurship, how much would you remember? And how relevant would it be 10 years from now when you needed to use it?
Right.
You need to learn in the moment. Now, history is important, because why not learn from somebody else's mistakes? All right. But also we have to interpret it in the moment. Just like we talked at the beginning of this podcast, the way we think about banks has changed. People have to change with that. That's not necessarily the utopia to finally have a bank loan. That may be the biggest anchor you put around your business.
Right.
So it depends on the circumstances, the moment, the time, and who you are. The entrepreneur's gut knows that, but they get too much outside advice.
Yes, exactly. Yeah, and that's half the battle, is when you talk about these traditional ways of doing things. It's my upbringing, I'm thinking, okay, I have this business idea. I need cash.
Right.
I'm going to go to a bank, or I'm going to go to an investor, But we talked about this in the past too. There's other ways to raise capital. There's, you've talked about Honeywell. Is it Honeywell?
Honeycomb. Yep.
Yeah. There's crowdsourcing or crowdfunding sites
There's
like
people
Kickstarter.
that will pay you in advance.
Right.
All right. Working on a project right now, and the principals we're looking at this one with. They went to the market and said, we think we can get a deposit in advance. Mm-hmm. So if we can keep our operating costs low enough, we don't have to borrow much.
Right.
All right. But that's just another way of looking at, one client, I said, well, if you ever ask for a deposit, oh, no, they'll never, no. I said, try. They came back and they said, yes. Well, when you're in a limited supply chain, limited people, there's a more willingness to grab hold of what they can get and pay in advance so that you don't disappear.
Right.
All right. That's, again, being nimble, staying with the motion of it. Or those who are willing to partner with you. This is often in the food industry. Co-packers. You have a great idea, whether it's for coffee or a beverage or whatever it happens to be, or a vitamin supplement. The co-packer may be willing to pay for the packaging, the labeling. Then they make it for you. And when it's sold, they get paid their portion, you get paid yours. They'll take that risk with you.
Okay.
That way you don't have to have as much cash. The other advantage, too, is if they're a professional packaging company, they've met all the safety requirements, all the health and standard requirements. You don't have to pay for all of that compliance. And it's done. Mm-hmm. All right. There are other ways to fund a company other than having to own everything.
Gotcha. Hey, guys. Sorry for this ad, but this is the ad to end all ads, because we are now on Patreon. Click the link in the description below to join and become a part of our community. More information will be announced this month. We are very excited on what's to come for our patrons. Now, back to the podcast. For me, with my business, partnerships have been huge. Yeah. Sometimes even not so much how you were explaining in the food industry, but we work with a marketing company where, they refer work and we refer work back. And those partnerships help kind of, I don't want to say fund our growth, but in a way they do, because that's not a lead or a clientele we would necessarily be.
Well, when you're working closely with somebody, where they're really funding you is they're not wasting your time on things that aren't beneficial to you. Mm-hmm. That's really critical. You could hire a marketing company to send you leads, and if 90% of them are a waste of time, that's 90% of your time that you didn't get paid for.
Right.
If you're working with somebody that they know what you need and you know what they need, when they refer something, at least when I was in the days when I was selling loans, if I wanted to bury a competitor, I sent all the bad referrals to them. Kept them real busy, right?
Right.
So, but again, sometimes the funding is by not making us spend money that we didn't need to spend, rather than just flat out giving us money.
Right. Yeah, and I think that's, too, I was always told growing up, you got to spend money to make money. I mean, that's true.
Right.
I'm not saying that you can't, but, as we've as I've matured as an entrepreneur and as a business, learning where to kind of cut costs, and only kind of spend on what is absolutely necessary.
Can I phrase that a little differently?
Yeah, please.
Okay. Because I'm not disagreeing with you, but I've learned to phrase it a little differently. Not necessarily where I cut costs, how to be more efficient. I may spend the same money, but I'm getting a better return for it. That's critical. And that's critical right now. If I'm spending money on an employee, finally hire that first employee, if you don't give them the resources and the right space to work and to do it, you'll spend all that money and not get anything in return, or you get very little in return. If you do, then that's a valuable investment in that person. When I finally could hire my first employee, she was getting overloaded and kind of frustrated with the paperwork. And I said, good, you can hire somebody to do the paperwork. For every $1 you're billable. If you make me $1, you can hire somebody.
There you go.
All right. So she found a way to organize her work so she could do more work for clients that was billable and hire somebody to do the work that she found boring. All right. I didn't have to orchestrate that. She figured it out. All right. So there are ways we can be more efficient. So I wasn't trying to cut my costs. I was trying to get efficiency. Yeah.
Yeah. I mean, that's awesome. And that's another thing too, kind of, I'm going to use the term commission, in my industry, like with some of our account managers and stuff like that, we're really big on I'm big on incentivizing employees because, the best way to raise funds is if you can kind of do your service or have your product out there and have your profit fund what you're trying to do.
Oh, absolutely. Absolutely.
I mean, that's a dream.
That's a big piece of the funding, though, that many people are lacking at the moment. They think, well, I've got to go borrow money or get an investor or crowdfunding or something like that. Why not just improve your what's called a margin? All right. The margin is the difference between what you charge and what it costs you to deliver the product. All right. So why can't I raise my price? Have you tried?
Right.
Some companies are amazed if they prove they're good and they're really good at what they do and there's a value, they can raise their price incrementally and nobody complains because it's a good product. So if you're trying to be more efficient in the way you create that good or service, you're saving money. But if you spend that same money to do more of the same thing more efficiently, but make sure you get the margin. And today it's hard because what we pay for labor, what we pay for materials, we pay for internet time, whatever we pay, it's not even. Some have gone spiked high. Some have been some have even gone down. So you can't just apply the inflation factor to everything.
Right.
So you have to look at your pricing periodically. I would suggest companies, if they've priced their subscription, their service, their consulting, whatever it is they're doing, or their device, go back and reprice it in today's market with cost. And that should be a standard piece you take a look at annually at least, if not quarterly. Have a regular little format you use to test it. Because one of the companies I watched, been around 100 years, it's a long-time company, but they weren't watching that. And he kept complaining that his margin was getting smaller. His prices were going up, his costs. And in some cases, they were going up faster than inflation.
Right.
Right. But that's a way to fund your company by improving that margin. And if you can't raise your margin, why not? Is your product not valuable enough? Are there things you could do at low cost that would make you more valuable? So they'd be willing to pay more. I know this sounds really silly, but some of my clients have said one of the benefits they have of having me is my contact list.
Yeah.
It's a resource, okay? That doesn't cost me a thing to share that. I build that just being who I am and what I need to do to grow my business. But they're willing to pay a little premium because that they know they can call me, and I probably know somebody who knows somebody that can help them with whatever it is they need. So you take a look, but you have to periodically look at that. What am I paying for what I have, and am I getting the right return? And how can I be better at what I do?
Yeah, absolutely. And I think too, like you and I talked about this in the past, and you had mentioned, review your prices and increase them maybe, yearly or quarterly. But right now I think it's people understand. Like there's a lot of our vendors that we work with have increased their prices, and I'm understanding of that because the economy, inflation, things like that.
That's right.
So I hate to say it, but for if there's any good time to increase your pricing, it's probably now.
Well, it is. Yeah. But then because everybody's doing that, and this is not said in a nasty way, but some more stealth than others.
Right.
So you may not have noticed. Like we've been to my husband does most of the shopping for us, thank the Lord. But he'll bring things home and he'll say, "This is the last box we had, and this is the box we got this time. They're 2 different sizes, same price.
Same price, yeah.
This one had 16, this one has 12. All right, that's a little more stealth. But you have to look at what those costs are, or regulatory compliance is a big thing that's going to go up. Many small businesses are going to be facing more and more regulatory scrutiny, which is going to be a cost. And they have to factor that into what it's their cost to run their business.
Right. And I want to talk about, kind of the regulatory thing again, because in my industry, in the tech world, we're starting to be more regulated with, kind of COPA laws and different data regulations, stuff like that, which I'm not saying is a bad thing. But, and with one of the SBA meetings, I kind of put that in the chat, is my big concern is that for the small businesses is a lot of those small businesses and startups don't have the resources to actually stay up to date, to maintain those regulations. And that's going to kill small business.
Well, there are 2 regulations right now that are out there. What that means is the regulatory agency has issued the rule. It's open for comment period, both of which are going to could have a devastating effect on the tech industry. A lot of other industries as well. Mm-hmm. One is what's called the independent contractor rule. This is brutal. Mm-hmm. In the past, if somebody was truly independent, they'd come and go on their schedule. They could make a profit off the work they were doing from you. They could be an independent contractor. Now, if they're doing the same work as anybody else in your team, you have to make them an employee. If they have longevity with you, you have to make them an employee. Well, some of my independent contractors have been with me a long time, but they have no desire to be an employee because they don't want to tell me when they don't want to work. Right? Yep. But this is what they're trying to push. The other thing that's going to be impactful, and particularly in your group that you work with, who partner so well together, it's called the joint employer law. And that's another new regulation. These are not laws, these are regulations that are saying if you and I are working together and we're providing each other services and we're partnering. We don't have a formal partnership, but we're working together. So that some of your people are working on my stuff and back and forth. We're now considered joint employers, which means if you violate a labor law, I'm liable.
See that?
Plus, your employees, plus my employees, plus the other joint employer they put together, could put us over that magic exemption of 50 employees. All right? So these are regulatory things where what's made the tech industry so nimble and so versatile and so able to spin around and do what it needs to do is this ability to have independent contractors and to form these partnerships. Now they're coming saying, well, they should be, and this is basically unintended consequences. The people who have written these regs have said publicly that they want to protect the Uber drivers or they want to protect the person working at McDonald's and let them unionize. What they don't realize is this is a standard business model in the U.S.
Right.
It enables us to grow without more financing because we can then reach people who have figured out their own finance, and then we can work together, and together we're stronger. Right? But the unintended consequence is going to drive a lot of that business model will either be forced to be broken up. So the only advantage, people are trying to fight this. And if anybody listening to this wants to go to nsba.biz, go to the action papers and file comments. Unlike a law, we can't threaten to vote our legislator out of office.
Right.
They're bureaucrats. But if they don't address all the comments and all the concerns and it goes to court, it'll get thrown out as unconstitutional.
Well, that's actually very interesting. I did not know that.
Yeah, I just found that out a few weeks ago. So it's very important. The comments are very important. Most people say, why bother? Who's going to read them? That's why they matter. So the one on the independent contractors already had 54,000 comments.
Right.
So DOL's having a little trouble meeting all those.
I mean, we obviously, we use independent contractors all the time. And to your point, they like that. I have never had one of them approach me and say, can I be an employee?
Correct.
Correct. And,
I've offered and they've said no.
Yeah. It's because they set their own rates. And that's what people aren't understanding is if they become an employer, I'm going to pay them probably a lot less.
Correct.
Than what I'm actually paying them on their rate,
Correct.
And, I get the point of like, Uber and, McDonald's and some of those regulations kind of make sense for those companies. But again, those are large corporations.
But even though it's not really a large corporation, each McDonald's is owned by an individual. He's a small business.
True.
So if this joint employer law goes into effect, corporate is now going to dictate how he treats his employees. Maybe he treats his employees better than corporate. All right? With the independent contractor, if you have to make them an employee, now they can't say, hey, you know what, Antonino, I need Monday off because my kid's got a game. So I'm going to work extra time on Friday. You don't care. He's an independent contractor.
Right.
An employee, you can't let him do that because he'd be overtime. All right? So you have to say, no, I'm sorry, I can't do that. Well, you always did it for me before. Well, that's before you were an employee. Now I'm under labor laws. All right. But again, we have found as small businesses creative ways to finance by leveraging off each other. And that's enabled us to do without having to borrow more or get more investors to do that. One of my clients said, I should go in this new direction. This is important. I've got to find the money to hire the specialist. And I went, why can't you do it? There was silence on the other end. Yeah, why not? All right, because we've trained too many people.
Mm-hmm.
If you want to do it, you go get the expert. Sometimes it's the novice who comes up with a new idea.
Right.
All right, that's when you need a little support for somebody who said, well, you came up with a great idea, and let me show you how to do it.
Mm-hmm.
All right, but you didn't have to hire them. So, but this is how we fund small business. We get creative. We know when to spend an hour on the expertise we need. The hard part is bringing other people in to do the work because you can't do it all yourself.
Right.
And that's as you grow, that's the toughest part. How do you fund that incremental growth? And that's a piece to look at. But if the party you're bringing in is going to add value to the company, there's two ways to do that. One, they're going to relieve you of non-revenue generating activity. Keeping up with your cybersecurity, keeping up with this or that. It's all critical, but it doesn't really generate you revenue. Mm-hmm. So if they free you up to go sell more, that's how you fund them.
True.
Okay? The other piece is maybe they have a talent that you could bill your customers for. One of my employees, she's truly an employee, started out very simply, but she's got a master's in big data. So occasionally I'd bring her in to work on something that needed organizing the data. And now she's so billable, I've got to hire somebody to take the mundane work off of her, right?
Yeah.
But again, it's look at who your workforce is, and they can maybe help you self-leverage. So all you're covering is maybe a month where you're paying them while you're waiting for it to pay off. But be creative about that.
Mm-hmm.
Don't just assume every employee has to be dead weight. And that's how you can fund without having to go to the bank to borrow.
Right. Yeah, I mean, absolutely. And honestly, how you're talking about, what was the term you used? Not, or non-revenue generating.
Right.
Work. As a business owner, as an entrepreneur, that stuff that bogs me down.
Right.
Costs me money in the long run.
It surely does. Absolutely it does. And that gets more and more. You talk about regulatory issues. I've been at events where the regulators come, and they mean to be helpful. We were sat at one day in D.C., and every regulator was speaking, and, we've got on our website, and we'll come out and train you, and you've got all this information, and you can do this. At the end of the event, one man put his hand up and said, that would be a full-time job. Do you want to come do my job for me while I go do that?
Right.
So, but we need people that just have their ears and eyes open for us and know how to fill out the forms and the stupid stuff that happens that we have to deal with. Every time EasyPass doesn't read my transponder.
Right.
Somebody's got to respond to them to say, the money was in the account, so I don't have to pay the fine. Mm. All right? So, there's a lot of that we need people to do for us so we are free to make money to pay their salary.
Right.
That's a form of funding that people don't think about.
Yeah, and if I want to go back for a second, back to like the educational side of things, because I think I mentioned I've mentioned this to you before, where I grew up and I was interested in entrepreneurship and business because I didn't know a single business owner that didn't have a lot of cash. Mm-hmm. And it's like, well, where did they start out? because they probably had no money when they first started.
Absolutely.
And that's why this whole idea of funding is so interesting. And I was talking to someone this past week about how our education system doesn't teach kids, important life lessons. Like I didn't know how to like I had to reach out to you and other people to say like, hey, I want to start this business. How do I make sure that I don't completely damage my personal finances?
Right.
That educational part is not, very transparent in the United States.
Well, and that's so true. And it's particularly true. We talked about underserved markets. Now, there's a government definition for that I don't think is true, because women fall into underserved markets. Do you really think I'm inferior just because I'm a woman?
Right.
All right. No, I don't think so. Right. But what happens is, if you did not I did not grow up in an entrepreneurial community. I grew up in a retirement community. All right. So I had no role models of entrepreneurship at all. So it never occurred to me to do that. So once I started doing it, I'd have people around me to help me understand how you did that and what you needed to do. So that's an underserved market. Not that they could be bright. They might even come from money, but they've never had that knowledge. So we need to form around, and they talk a lot about the underserved markets don't know how to borrow. Well, first you got to know how to have a business.
Right.
And then you have to know how to fund it. Otherwise, you will borrow inappropriately or borrow the wrong amount. And you need to have those. So if you didn't have that growing up, and I didn't, I had to find it. And I had to find it in people who were willing. I never forget when I learned what treasury stock was. It's a funky accounting thing. I couldn't figure it out. So the guy that was helping me, he was one of my referral sources. He took a napkin and tore it into pieces, and each one was a stock certificate. He dumped all the change of his pocket out on the table. We were sitting there having pie and coffee. And we bought and sold stock, and he was keeping a tally until all of a sudden the lights went on. I knew exactly what we were talking about.
Right, yeah.
All right. I didn't need to go take a college course for that.
No, yeah.
All right. But somebody was willing to teach me that I didn't have at the kitchen table at home.
Yep.
My father had worked in a factory. He had no idea.
Yeah, the best education I've gotten as an entrepreneur to help my entrepreneurial career is experience.
Yes.
Failing, learn from my mistakes, adapting, and and to your point, you've been saying this multiple times this episode about small businesses being able to quickly adapt and be flexible, and letting the funding sources be in line with that flexibility.
That's right.
And that is, you have to be able to trip and fall, adapt, and keep moving forward.
That's exactly right. And there was a time when I was lending, and I had a boss that said, don't be afraid to lend to somebody who's gone bankrupt. They learn lessons. And if they're back in business and making money, they're the smartest risk you can have.
Yep.
I hadn't thought about that. He said the person who's never made a mistake and never fallen, he won't know how to pick himself up.
Absolutely.
Right?
Absolutely.
So we, as an entrepreneurial group, need to help each other that way. What I get frustrated with is everybody stands up and tells their success story. Great.
Right.
Tell me what it was like in the beginning. Tell me those nights that you didn't know, you couldn't sleep.
Mm-hmm.
All right? Tell me how you got through those, and let's help each other to do that. All right? That's where we learn. So as we come together, and how do we want to be funded then? Don't give me $1 million
right.
if I don't need it.
Mm-hmm.
All right? And then make me go out and raise money to pay for it. Let's figure out what I need, when I need it. Let's have funding the steps, and let's have investors who understand that. You don't have to raise $10 million and hire everybody in your C-suite and pray you sell your product. I have one client now that did that. And the product, for no fault of his own, it has to do with federal approvals, didn't sell. Mm-hmm. Now it's beginning to sell 8 years later. So he had to lay off all the C staff. All right. He's got all this investor money that's gone. All right. And he said, Marilyn, I learned the hard way. I'm not doing that again. Mm-hmm. All right, next time, so because we were talking about somebody he should hire, he goes, I'm not going to be so fast to hire again. Because he's got a new drug, it's a drug, new drug out there that's phenomenal. All right, and it's going places, but I'm not in any hurry to ramp, spoken from experience. But we need to help the funding sources understand that. Mm-hmm. I don't need 10 million. Maybe you just need $1 million, a little guidance, some insight.
Right.
Eventually I'll come back to you for 9, 8, 50, all right?
Yeah.
But let me get there. And the other thing is, not all companies have to be big. Look at the issues Amazon has had because it is so big. Mm-hmm. but maybe it was more nimble and it was better when it wasn't so big.
Yeah. I think the flexibility, I always pride myself with that to clients. I had one client, say to me, he's like, I'll be a lifetime client as long as you can maintain the same level of flexibility with me that you have in the past. And it's like, I said, absolutely. But I'm thinking to myself, like,
how am I going to do that?
How am I going to do exactly? Because one thing I've learned too is as I've grown, I've kind of stepped away from that, client facing, every day something goes wrong, give me a call.
Right.
I'm more of like, check in every quarter, every 2 months or something like that.
Well, that's where my business model has shifted and changed. I was following the more traditional. I have to step back. I have to delegate. I have people do. Most of the companies I work with are really good at what they do because the founder has a particular piece of genius.
Mm-hmm.
All right? And if that piece is hidden from their clients, the company becomes like any other company. So I'm trying to find a way to still have that piece. And how I do that in a couple of different ways, because I've now got a big enough team they can't all be direct reports to me.
Right.
So we're trying to figure out, and we're working on a model that I think is working. We're starting to get this. I've got some high performers, for example, who want to learn how to think the way I think. God help them, but they want to learn how to do that, right? And so we're evolving that so that they can give that same, but I'm still that piece. I'm still called in occasionally as a piece rather than completely stepping back, because that's what sets my company apart from others that do what I do. It's a different model.
Right.
And we're thinking through this model. Another generation, you went secretary, went to this level, to up, eventually got to the president. Mm-hmm. Right? These days, technology has squashed that down, that we don't need all those layers in between.
Right.
But nobody taught the people at the top how to handle that much data. All right, so we're working through that. So the same as we go now with this business model, there ought to be ways that you or I can still give that little bit of a personal touch that makes us stood out in the market forever without being so bogged down that we're doing everything
right.
that we can't grow the company. And so I've been experimenting with that my whole career. And every year I run away and do a business plan. And this last change I think is going to take.
That's awesome.
Yeah, I think this one is going to work.
Yeah, I love that. I mean, flexibility is huge. I think, I always say innovation is the key to success in any business,
right.
large or small. But with the small businesses, the ability to be flexible is huge. And right before we kind of wrap up this episode, I like to ask everyone I kind of interview on here a question, and that is if you can give one word of advice to a new business owner, an entrepreneur, or a startup company, what would it be?
Don't think you're small means you're insignificant. Don't think that. Don't think just because you're not as big as Amazon, you're not important. Small companies do amazing things. And with technology today, we don't have to be an Amazon to change the world. There's a wonderful book called Small Business, Big Thinkers by Cynthia Kay. Mm-hmm. She's in the process now of rewriting it. Disclaimer, I'm a piece in there. But, but the whole idea is because we are small and nimble, our smart, our drive, our passion is enticing to the big companies because they've lost it.
Right.
So we can't. So if just because you're small, don't think you're unimportant and can't change the world.
I love that. I have to say that's probably one of the best pieces of advice we've kind of gotten on the show. And because one of my favorite quotes is from Steve Jobs. He says, it's the people who are crazy enough to believe they can change the world that do. And he started out very small too. So that's fantastic advice. Yeah. So Marilyn, thanks again for coming on the show. We really appreciate it. Love having you. And hopefully we'll do a third episode with you because you seem to be a popular topic.
Good. Well, I enjoyed the conversation. Thank you.
Thank you again.